Good afternoon. Good afternoon, everyone. I'm Bagadon at Stock Market Caddy, and it is April 16th at about 3:30. We're going to be making the Sunday video today. Hopefully, we'll complete it today. We may not, may actually get completed tomorrow. We may do this in segments. But we have added a number, and we thank you, a number of new monthly members. And they're receiving the nightly video, and they're kind of wondering in places, as you might have recalled when you first started, it's like, what is this? What is this all about? What is he showing me? How might I use it? So this video that we're making is going to serve two purposes. Number one, to review the market in complete view for April 17th. However, we're also going to take a little extra time to explain what each whole number, you might think of them as modules. We're going to call them whole number one, whole number two, whole number three, and it goes more than 18 of them, what the tool is and what it is showing. Now, we won't show on every video, not even on a Sunday. Today we're going to go through them all, but on most videos, especially during the night, we want to maximize your time. We'll only be showing a handful of the holes and information. This information in the hands of a good acquired swing trader, option trader, will hopefully serve to help you affect positive trades. If you have any questions following watching this tutorial, what these videos are doing, what they're showing, any specific questions you have on any of the individual tools, please don't hesitate to reach out to me, and I'll be happy to explain to you what it is and how it was constructed and how we use it. We're going to try to do that here, though, and take that extra time. So please understand, though, we're not going to do this every night. It would be way too long. In fact, our goal is to get the nightly video down to a very manageable 15 minutes for each person. Now, we don't know, there are going to be evenings when folks just can't watch, and we understand that. We don't want to cut any corners, but we're going to try to get it down to a very salient 15 minutes. Some evenings, there might be a market commentary from me. We'll put it in the table of contents. And some nights there may not be. There isn't always something to say about the market necessarily every day. So we want to maximize your time. These videos will have a table of contents if you're looking at it now through the screencast tool. There is at the bottom under the settings, if you click on it, I don't have it right in front of me, but you can hide the table of contents if it's in your way. The idea being is that maybe on a particular night, there are certain holes. We're going to keep them pretty much in the same order, or we will keep them in the same order. Maybe you want to click on just one aspect of the nightly video. That'll be up to you. I hope that makes sense. Let's get underway. Hole number one is our Nicholas daily timing model. The Nicholas daily timing model is not a trend identification system. It is not. What it is an algorithm that is running a chart that there's nothing to glean from. It's a math formula that assesses the data of the ES contract, as an example, the VIX contract, and the 10-year Treasury. From that data, it makes a decision to buy or sell on a daily basis. The signal will come in effectively at 5, but won't get posted until 6:01. 6:01. It needs to open up one tick. And it'll tell us whether the market is long or short. Now, for annual members, they can run this model and they can optimize it to its maximum profits, its maximum time frames, and so forth. This is not optimized, so we're using it as a guide. It is meant to pick up market vibrations. Market vibrations. When the vibrations in a market start to rise, risk a perception of increased risk, the market will frequently turn down. When those vibrations get suppressed, the market has a tendency to turn up. A tendency. It is not a guarantee. And we remind everybody, these are leveraged futures. And if you try to take these on an overnight basis, you will be expected by your brokerage company to have ample sums available. Initial capital plus. Okay, so just be aware. We have many members that will use this signal in a lot of different ways. They may take an individual, they may take them all. They may take them with multiple minis. Some folks are fortunate to be that well capitalized. Some may choose just minis. Some may choose just one market. Some may choose to do it with micros. Some may choose just one market with a micro. Some may not take the trade here at all using futures contracts, but use option contracts over an extended period of time. And yet others may not take the trade at all and just use it as a barometer as to what side of the market they might want to be playing. A lot of options. There always are. So the ES contract is shown through Nicholas to be long. It went long on the 13th. If one had taken that position, they are in fact experiencing a drawdown. The Russell, long. The Dow, long. The NQ, long. The VIX daily component is actually short. What is the VIX daily component? The VIX is built into the model here, and we also have a separate algo running separately on the VIX. The VIX, particularly this VIX on the as it relates to the S&P, is very much the inverse. If the VIX is short, most of the time the market is long, the S&P. The VIX, frequently referred to as the fear gauge. What is it and how do we use it? The VIX is a reflection basically of folks buying, investment firms buying, hedge funds buying calls and puts. When they're bullish, they will be buying calls hand over fist. When they are bearish, when they are fearful, they will be buying puts. And it gets reported on as the VIX on the S&P. Now there are VIXs for all kinds of markets. Could be interesting to know. Gold, oil, VIX, and so forth. Here we're focused on the VIX on a daily basis that has a direct impact on the S&P. S&P is the biggest, deepest, most important market in the world. And as it goes, so goes just about everything else. The VIX has been telling us that it has been risk on in the S&P for some 19 days. That's what it's telling. The VIX has been suppressed. There has been an appetite for risk. The trend is moving into chop. There is a little bit of pressure up, and there is a little bit of buying. It could be a warning, but we don't want to overread it. We further use something called the spot VIX, 9-day, 30-day, 90, and 6 months. These are option products, and we want to pick up on the trend of the buying and selling of the spot VIX. The 9-day has also been indicating risk on for 19 days, and it's even telling us risk on resumes. It's moderate. There is a little pressure up and a little bit of buying here too. Could be a bit of a warning. 30-day, 90-day, and 6 months, it's actually telling us risk on pause. And there is a little more pressure out here. So maybe there is an event further out that the VIX market is concerned with. Once again, if the VIX rises and starts trending up, that isn't good for those that are bullish equities. Okay, so right now, the VIX structure as what we're seeing here tonight is in a trend down, indicating that there should be buying pressure in the market, and maybe that's lining up with what, in this instance tonight, what Nicholas is also saying. We'll have to see. But there is some buying pressure, and this can change rapidly. So we're trying to put together each and every night, each and every week, a bit of a mosaic to stay in sync with the overall markets. VIX, the fear gauge. Hole number 3, the skew. By the way, there are educational videos in our tab for new members under Caddyshack. And if you haven't seen those, you might want to. And we go into more detail about what the skew is. The skew is not a very good timing tool, but it does give us some information that I think is important to know. And at times, it can really let us know when we're at extremes. But this is the skew as it relates to the S&P. For now, a skew reading over 130 is reason for concern in this instance. But it has come in. It has come in quite a bit. And the skew reading is a day old, right? So it's not the best timing tool. When we get a skew reading, and it's also an inverse product, but when we get a really high skew reading, and the market is really high at the same time, it can indicate a tremendous move down. And it did so over here and over here and over here. This is the S&P chart that we have underneath. When we're at extreme lows in the market, where we have sold off really high and the skew is still high, it can mean just the opposite. So we will guide you as we go. When we see those conditions where the skew is telling us that the market is bracing for a significant move one way or the other. Equally, when the skew gets to a reading that is below, so above 130, the bulls need to be concerned. Especially when we're at market highs. A reading below 120, the bears need to be concerned. Okay? But it also depends upon where the market is. Is it at highs or at lows? And we will describe it. Our interpretation here today, this weekend, is that the skew is well off of its highs. And the market, it's not indicating that we're going to see a big collapse. Anything could happen, but it's not indicating that to me here this evening. What drives the skew, when the market goes to highs and there's a fervor to buy stock, the big money, the Warren Buffetts of the world, they may not sell their shares, but they will do what? They will sell calls to the speculators, receiving premium. And they will take that premium and they will buy puts, so that when the market corrects, they can close out for a whole chunk of cash. So Warren Buffett, he is correct when he says he sell, but he's less than complete, because he doesn't tell you that he does buy and sell options around his positions all the time. But right here, right now, skew is elevated, should be of concern to the bulls, but it isn't outrageous. Hole number 4, the yield curve. Now the yield curve, we want to take a minute or two, and I want to explain to you what you're looking at. This is the yield on 13-week paper. 13-week, basically 90 days. 5-year, 10-year, 30-year. What is the yield, Bagger? This is the yield right here, 7.48. But the way they report on it, it's not 7%. No, probably headed there. I'm only kidding. But It's actually, you move the decimal over a point. So it's actually, the yield is 0.748. So if you have your cash parked at a brokerage firm in short-term treasuries, that's the yield, 0.748. Very low, but considerably higher than where it was just a few short months ago. The 5-year isn't 27%, it's 2.786. 10-year, 2.828 and 2.915 or 19. That is the actual yield. I'm not sure why the average true range is in here, so let's remove it. We don't use it, so I'll save that. I don't know how that get in there. All right, and what's important to understand is the yields are rising. They're trending up, and they've been trending up for 71 days, 166 days, 75 days, and 75 days. Now, what does this mean? Well, if you own bonds and the yields are rising, what does that do to the price of the bond? It goes down. That's one implication. It also has other implications, many more than what we can get into here tonight. So once again, we point you to the Caddyshack, where we have a complete video on yield curve. But we want to pay particular attention to it. And what this graph down here is programmed to do, this is measuring the spread between the 90-day paper and the 10-year paper. And you can see it's pretty steep, 208 basis points. That's very, very healthy for the banks. Very healthy for the banks. Now, it had been very flat and narrowing, but it's very steep. Now, there will be a lot written about by the economists, and we will see it here. Just last week, though, the yields had risen so much on the front, what we call the front end of the curve, that the 5-year was higher than the 10-year and even higher than the 30-year, which is crazy, because if you got $1 million and you go get a CD for 5 years and you say, that's not enough, I want to go out 10 years, and he says, well, that'll be even less. Well, then I want to go out 30 years, and he goes, that'll even be less than that. That's one of the implications. But right now, that isn't the case. They are not inverted. And you'll be hearing and reading about the inversion of the yield curve. It is a fantastic tool. And there is definitely a lot to it for a whole host of reasons that we can't get into here. But just because it inverts for a day or two or a week or two doesn't mean that the world is ending. So please don't. It isn't that precise. The bond market is in fact the biggest market, the most liquid market, bigger than the S&P by many multiples the world over. So they're very, very important. And that yield on the 10-year, Bernanke, the former chairman of the Fed, was asked one time, what is the one thing that you look at in the morning? He says the yield on the 10-year Treasury. Okay, so the yield, and they have increased, and they certainly affect interest rates. I do think, you can timestamp this, it's 4:16. I do think that these yields on the front end are going to continue to rise. And I think that this is going to continue to steepen until it can't steepen any further. And we think that the yields on the 10-year and the 30-year will drop and drop precipitously. And that's when the yield curve will formally be inverted and be indicative almost to the extent of 100% that we have in a recession coming. Now, you may think that if the 30-year Treasury drops, that interest rates on mortgages and everything will drop. Well, they will, but in that environment, the banks can't make any money. This thing will begin to flatten, narrow, and go down. And yes, those rates, but the problem will be the banks will tighten their loan standards. And so it's in a situation where the yield curve inverts, two of the impacts is that it is actually money tightening. There isn't as much money available. Also, companies will find it much less attractive to buy equities and inflate their stock, to inflate their portfolios, and they'll be less apt to do that. And what do we know? Who has been the biggest buyer of stock? The companies themselves. So has been for the last 70 days a very big deal. in my view. The markets haven't really, I don't think, haven't really priced in what is occurring. That's my assessment, but we want to watch it, and we particularly will note when we see it inverting. Well, but it doesn't move dramatically from one day to the next. Yield curve. Hole number 5, the driving range radar for sentiment on futures. Now this you will see a lot of, and I love this view. This gives us all of our futures markets over here. What we're looking for in a nutshell here, there's a lot of information here, and we will pick it out over time. But the simplest tool is this. When we or any stock or market is in euphoria, the likelihood that it's going to move back toward its mean is some 95% over the next 20 days. Not a guarantee, but a high likelihood. And when it's in panic, it is likely to move back toward or back up toward its mean, to the likelihood of some 95%. So this is a great tool to look at markets on whatever interval. Not sure why my interval isn't there. Let's see, it should be. And oh, here it is here. Sorry, daily. It can help us get our back to the wall. And for those that like to trade options, I love to be a buyer of calls here, getting long, and a buyer of puts here, fading or shorting a market. Especially if you have some other tools that you can confirm that with. This is the driving range and the sentiment. So when we look at this, what do I see? I see the indices not in panic. So they could go lower. They are definitely weak. They are below the mean, and they are moving into panic or moving out. Maybe they're moving out, but they're on this end. This isn't where I want to initiate, for me, getting short or buying a put. I would rather be looking to try to go the other way. Also, too, if the markets are in panic, why isn't the VIX over here? It isn't. It should be. Now, we're getting ready to close a vertical put spread that we put on, and when we put that on, where were we? The markets were in euphoria, and the VIX was in panic. And what did we do? We got a vertical put spread on. Now the markets are nearing panic. They've moved all the way back down, and the VIX is somewhere in here. We want to close that. In round numbers, we have that VIX structure that we put on has returned a 5-to-1 profit factor for Susie and I. Very nice trade. Let's scroll down and see what other markets we see at extremes. 30-year Treasury. Almost panic selling. Why would they do that? Because the rates are rising. Do I want to short Treasury? No. I would be more inclined to be a buyer of 30-year Treasury. What would that indicate? That maybe those 30-year rates are going to come in. And I think that's probably the case. Heating oil, pretty extreme. Nat gas, pretty extreme as well. And now the softs are also extreme. Don't have to, there's no suggestion here or recommendation to do anything, but that is our educational view on the driving range sentiment as it looks at the futures. Hole number 6 is exactly the same tool, only using the ETFs. So if you like to use the ETFs, what do we see for extremes? The gold miners. And this is minerals and mining. Metals and mining, little extreme. Likely to come in, but it's virtually the same. Futures will lead. That nat gas in euphoria, if you're in it and you've ridden it, great. But maybe as well, maybe that's a product you want to sell calls against your position, or maybe begin to think about playing it for a reversion to mean coming back. Dollar, very strong, UUP. Emerging markets, I don't want to be shorting them down here. I might want to be thinking about buying them, maybe. As a trade. Sentiment, ETFs. Hole number 7, the driving range, sentiment for the Dow Jones. So let's sort what stocks in the Dow Jones could be setting up the best for a bounce. Cisco, Microsoft, JPM. What stocks might be looking to come back in? Exxon, Caterpillar. Sentiment radar for the Dow. Hole number 8, the S&P through the eyes of the sentiment radar. Let's give this, and we also come here a lot, but let's see what stocks, look at all this. All these stocks are in the panic column. Let's see just how much. It's quite a few, about 37. These are not stocks that I want to short. I might be interested in these stocks as a trade to the long side, playing for the bounce, especially if I think the market is bouncing. How about stocks in euphoria? There's the whole S&P 500. These stocks, these are the most, at this current time, the most euphoric. If you're in them, congratulations. If they're in here, I might be selling calls against the position, trying to extract some extra income. Or if I'm, want to speculate, I might want to play a put spread over the next 20-25 days, expecting, can't say for sure, it's a game of probabilities, that it'll come back to the mean. When you're trading stocks, be very mindful, especially options though, where the earnings calls are. We're entering into some earnings. So we don't like to get options on in front of earnings. You pay too much. This is the sentiment radar for the S&P 500. You'll see this a lot. Hole number 9, the sentiment radar for the Nasdaq 100, and we are halfway through. We are rounding the corner. This video is scheduled at no more than 1 hour. This is not every night. There is no way we would expect you to spend this much time. When you have these tools on your desktop, though, you can maximize your time, as you see fit. During the week, we will highlight a handful of these indicators into a short 15-minute video. Some of these videos will have commentary, some won't. Some will just play music, and you can interpret and slow the video down as you see fit. Remember, Stock Market Caddy, we're not making specific recommendations to buy or sell anything. We are a mentoring site. We are trying to help you learn to trade your own game in a mechanical fashion. Let's look at the Nasdaq 100. These are the stocks that are most overdone. They have been panic selling them. These might be the stocks I would be interested in on the long side as a trade. Over here in euphoria, there's very little. Dollar Tree, Ross Stores, pretty much tells you how weak the Nasdaq has been. Maybe it's ready to do a bit of a bounce. Hole number 10, what we call the consolidated view of all the futures through the eyes of Swing Machine, which is in fact picking up on the trend on a daily, weekly, and monthly basis. This might be for the swing trader. The longer term, mid-term investor, certainly the investor. As an example, the VIX has been short on a monthly basis for 21 months. 21 months since August of 20, which is interesting, right? And you wouldn't think that. Now we're going to scroll down. We can't possibly comment, but as an example, the Russell on a daily basis is short. Weekly basis, short. The monthly investor, it's just the dip. If you are a swing trader, we think that swing traders should only pay attention to the closes and not the intraday action unless they're just getting ready to cash out. and want to try to fine tune their profit. But if you are a weekly investor, you definitely, in our view, don't want to pay attention to the intraday traffic. You may not even want to pay attention to the daily closes and only the weekly closes. And a monthly investor, you certainly don't want to pay attention to the intraday traffic or even the daily traffic, maybe the weekly, but better yet, not make any decision. Let me show you as an example. NQ daily short 5 days, making money. Weekly 9 weeks, making money. Monthly investor 147 months, making money. This can be a great tool to hedge and wedge long-term positions. We can't get into that here and now, but let us scroll down and let you slow the video down on any market that you might be interested in to see how Swing Machine is positioned on a daily, weekly, monthly view. Some incredible trades, investments. Everything to us is a trade. But we'll give you a chance to see all this. And now let's slide over. And this gives us the support and resistance levels. This is support daily, weekly, monthly. Center cut, high, resistance. As a general rule, I'd rather be buying off of here from entering. As a general rule, I'd rather be fading off of here or maybe selling calls. Let's scroll up so that you can get a chance to see where your favorite market might be. And we can pick out extremes. Gold on a weekly basis is up into resistance, likely to come in. Not a guarantee, but likely to come in. The S&P on a daily is on the first level of support, even on the weekly. Hole number 11, the consolidated view for stocks and ETFs on a daily, weekly, monthly view. And we're simply going to scroll down with the expectation, and when we do this, that you will stop the video and examine the market that you are most interested in. We can't possibly comment on each and every one, but we'll show you each and every one. This is, now we look at the consolidated view only on Sundays. And now we can see the support and resistance levels on all the ETFs. Up we come. RSI is an old standby that's not proprietary to us. An RSI over 70 might hint of an area to take profit. An RSI under 30 might hint of an area to begin accumulating. This is the consolidated view of ETFs. Hole number 12, the commitment of traders report. Now we don't track what the commercials are showing, but we do track this group, the non-commercials, which are the big hedge funds that we want to pay attention, at least general attention to what they're doing. The small specs, less so. We are not small specs. We're smaller than that. These folks, both of these folks have to report their positions. It's week-old data. The banks probably have it by the hour. Public only gets it, and even commercial interests only get it a week old. Small retail traders don't even show up here. As a general rule, it's not a great timing tool, but it shows here that the big hedge funds, they are net short the ES, short the NQ, short the Russell, short the Dow. Telling. Short the British pound, long the American dollar, long euro, very short yen, considerably long gold, long silver, long copper, considerably long oil. Heating oil, basically flat nat gas, they're considerably short, and they're probably getting killed on that. Gasoline, long, Treasuries. They're considerably short Treasuries, but notice the 30-year. They are not. What do they expect there? Lower rates. Corn, very long. Cotton, long. Coffee, long. Wheat, long. Sugar, long. Cattle, very long. Commitment of Traders Report. We only look at this on Sundays. Hole number 13. Hole number 13. This is the breadth indicator, Mcclellan Oscillator, and it is showing us on a weekly basis that the breadth of the market is not good, as the market had been going up and continuing to correct. So the overall breadth of the market is declining. Markets cannot sustain themselves at highs if the breadth of the market is not expanding. They will fall from their own weight, and that's what we see here. And it had been deteriorating. This is a weekly chart for weeks and weeks. Then we get the break. This is the tell, and this does look still very bearish to us, and the breadth of the market is nowhere near where it was over here. Hole number 14. Now this is the daily futures. Now usually we don't show this on Sundays because we've already looked at the consolidated view. It's a bit repetitive. During the week we won't look at the consolidated view. We'll only look at the daily. So this tells us how the daily futures are positioned based on swing machine. What I do want to point out to you now for an educational standpoint is this column right here, the SMC intraday goal for futures. This is an algo that tells us if you are trading the Russell intraday, this is reasonably trading a mini, what you should be targeting to make, about $1,000. The ES, 1,800, the NQ, 3,900, the YM, 1,200. One mini. If you are trading micros, 1/10 that size. And you can see the other values for the other markets. Otherwise, Swing Machine is doing what we described earlier. We're not going to go into great detail here and now, being Sunday, but we will, of course, during the week. And we slide over and you can see the support and resistance levels on a daily basis. And we'll slide up and show you. Hole number 15 is exactly the same, Swing Machine, on a daily basis for the ETFs. Now we don't really even need the volume here. We'll remove that. We don't have the intraday. We could put that in, intraday goal. That could be loaded in. I don't have it loaded in here. But let's scroll down and give you a chance so that you can see on a daily basis. It's exactly the same tool, only configured for stocks when it comes to calculating the purse. And then over we go, and up we come. And we will be showing these, or this view, on a daily basis just about each and every night. Hole number 16, the SMC Trade Generator Pebble Beach Triggers. Now this is a fantastic tool, especially for those that have this on their desktop. And we will look at this almost every night. This is not a trend identification system. It is more of a counter trend trigger. These trades with the stocks loaded in of your choosing, we have the S&P 500, are giving us the signals, a highly probable trade triggers, long and short, that have usually a length of about 1 to 5 days. But sometimes these trades can be the marker of something significant. So when they do trigger, it is worth a look, especially if it's in a stock that you have interest in. Let's bring these to the fore. The signals that came in on Friday, a Pebble Beach sell, green, sell, green, a buy, Caterpillar, 379. This reflects a $10,000 investment. but they're all in the green, buys and sells. But you would think of these as counter trend. I'm happy to discuss what this is. Basically, it is a highly probable candlestick formation on a daily basis that is being scanned for by the computer. And this was a style of trading that I did in the 2000s. We still do, but I automated it through this tool. Pebble Beach trade triggers. This is hold number 16. All these stocks on either side are worth a look for a 1 to 5 day trade in either direction. But do your due diligence. And if you are a new trader and you're just at a loss as to what would be a good technical entry, please let me know. And we can, hopefully, I think we have it in the Caddyshack, but can give you just some basics to make sure that you're entering at a relatively safe spot and know really where to put your stop. And here it does give you a stop out recommendation or suggestion. SMC Trade Generator, Pebble Beach. Hold number 17, another one that you'll see a lot of during the week. This is the SMC Trade Generator out of bounds, oboe. It's everything that the Pebble Beach is, except it does not take into consideration the candles. And here are the triggers. So on Friday, these stocks were generating buy signals, and they might be worth a look. This one was generating a short signal. SMC Trade Generator out of bounds, oboe. Hold number 18, SMC Put and Call Option Machine. This is the one tool where we look at moving averages to keep an eye on the sheeple. The 5-day, 10-day, 20, 50, 200 EMA. It tells us what percentage above and below the averages these markets are. Many of the fund managers will not commit new money if an indice is under the 5-day EMA. It's just one of the many ways that we will use this tool. And we will show you in more detail as the days come on and the more experience and the opportunities are presented here. But we can sort to identify the top 30 stocks that are racing above their 5-day moving average and very well could continue. We can identify the stocks that are racing underneath their 5-day. So we have the little rockets and the little torpedoes headed down. We can also come here, expected move. This is a beautiful tool. We can come in here and say over the next, let's say 10 trading sessions, tell us based on the pricing of options who is expected to make the biggest percentage move. The markets based on options are expected to move anywhere from 3 to 5% over the next 10 days. It does not give direction, but it could be up, could be down. This stock is expected to move some 20%. Could be up, could be down. This one, 19%. This is what it's giving you. We can give you the top 100 stocks based on their option pricing of where the volatility, what they will be doing in volatility. Could be earnings, could be anything. But the option markets have priced in a big move in those top 100 stocks in percentage terms. In point terms, this is how much the markets are expected to move up and or down over the next, we put in, I think, 10 days. And here are the stocks. A lot of times the stocks are the same. Amazon, 200 points. Maybe that's up. That would be a big call option. Let's show you the top 100 point getters. So if you're playing options, you want to be playing, you want to know where the jello is moving on the plate. And these are the stocks you would want to be looking at. We will look at this a few times during the week, and we'll look at it in a number of different ways as the opportunities are presented. This is the SMC Put and Call Option Machine matched with what we call the expected move to expiration. Hole number 19, the swing machine for stocks and for ETFs. This is all S&P 500. Now you can see why we can't show every segment every night. If it's on your desktop, you can pick and choose during the course of a day or course of a week. But we can sort. So let's do that tonight. These are the newest stocks establishing a long trend, confirmed right here. You might want to give those a look. These are the stocks establishing new downtrends. You might want to give those a look. There is much more information here. And we don't want tonight's video to be exceedingly long. But during the week, we will show this repeatedly, and we'll show you other ways to glean information from this fantastic tool. SMC Swing Machine for stocks and for ETFs. Hole number 20, the swing machine for stocks and ETFs. This is the Nasdaq 100. Exactly the same, only we've drawn a distinction. The earlier section was for the S&P 500. This is the Nasdaq 100. What stocks have generated new longs? Some of them share indices, so here they are. Doesn't mean that they're doubly important. It just means they share an indice. And here are the short signals. And we got one. Let me just show you as well, one of the things that we can do, don't get dizzy. I'm going to scroll down. You could look at any stock to gauge the trend, and we will during the week. But we can also come in here and look at those stocks that are on support and those stocks that are at resistance. I like to be a buyer off of this column. I like to be a fader or a shorter off of that column. And we can scroll up, giving you dozens and dozens of opportunities each and every night for you to cull out and do your due diligence from a trading standpoint. Now, if anyone, monthly or annual, if you are trading any of these markets, particularly futures, and you are using highly specialized charts, Rinkos, point and figure, and you are trying to mimic what a intraday trader would need to use, or a daily trader or an investor, and you're trying to gauge what the brick size should be, we use something called the SMC brick, box, or range bar dynamic calculator. As an example, if you are currently trading the S&P, the ES, the brick size calculator is recommending that the brick size for an intraday be priced at 5.33, thereabouts. So this is how much a mini would be for each brick or box. If you are trying to mimic a daily, it would be this size or that amount, or an investor, that size or that amount. This is a very important tool, and we're happy to discuss this in greater detail, especially with annual members, and how to use this to make sure that if you're using those advanced bar types, your trading remains consistent as the volatility expands and contracts in the marketplace. And this is how we do it. And we'll show you everything that's here. We can even give it stocks as an example. They're pennies, so that there's no calculation for the value. But if you are trading Iron Mountain, for instance, and you want to trade it intraday on a point and figure, it's recommending that it be about 4.5 cents, on a daily 22 cents, and on an investor 44 cents, as an example. Okay, tonight's video has a lot of segments to it because we're using this as an opportunity to bring up a tutorial, so we can go all the way through the major modules. There could actually be more during the course of a week. If anyone has questions, don't hesitate. But for the most part, you're going to be seeing a collection. It'll be much more abbreviated during the week, and we try to focus in so you have plenty of opportunity. So please know that. This is a fantastic tool. This is Swing Machine on an intraday basis. On a 60-minute basis, ES went short 6 hours ago, 7 hours ago, the Russell 2 hours ago. The VIX is rising against a short position 29 hours ago, and the YM long 27 hours ago. This 60-minute signal, especially for annual members that have this on their desktop, is a great tool. It is the tool that we use day in and day, well, not every day, but week in, week out, to help us place our options. It's great. If you have any questions on this, don't hesitate. Again, be sure that you visit the Caddyshack new members to get an understanding of how Swing Machine was constructed and what exactly it's doing. But this is how we're positioned tonight, and on an hourly basis, the markets are defensive and the VIX is rising. If the markets go short and the VIX goes long, we could be in a short position on an hourly basis that could last. We've seen hourly calls last for 2 weeks. Not always, but it could. So we always want to pay attention to what's going on in that hourly. This is a traditional daily view chart. We don't use this a lot, but we use it some. We have the traditional moving averages. I think they're 50, 100, 200. We only do it just to be able to see what the sheep think they see. We do use this tool a lot in a lot of different things. This is called the percent B. And we teach in the Q School how this is used. It is a fantastic tool. A fantastic tool. This is the bandwidth and volume we don't use a whole lot. When we look at this market on a daily basis, right here, right now, the market is in no man's land. We have folks that have ridden it all the way down, possibly perceiving this as an A to B and a C point and expecting another dramatic move down. That is our view as well. We think it's making that. But midterm, we have a move that has come up, took out these swings, and has pulled back, and it's holding here. It is possible that we start to move up, and if we take this out, it could catch a lot of people on the wrong side. So we're very much in no man's land. We put, our shorts on up in here and really throughout, but we'll be pocketing. We don't like where we are down in here. As a general rule, there's something called false lows and false highs that we can't get into here in this video, but as a general rule, we'd prefer to be buying in this area, the buy zone. And up in here, we would prefer to be sellers. So down in here, we're thinking, yes, we could get a spike low, but it isn't where you would want to be initiating shorts. In fact, you'd want to start, not immediately here, but you might, and we might, start thinking about closing out some of our shorts and maybe setting up for some sort of a bounce. And hole number 24. Now, there aren't many golf courses with 24 holes. Again, we thank you for your patience. This is a view that we do like to see quite a bit, almost every night. It's a wrinkle view on the S&P. And this clearly gives us some markers. And you can see these are C points down. The market in this view short term was running up. We were long. The market is now running down. We expected it to pause here. If it breaks this area, despite what Nicholas is showing, we could break precipitously and get on down to 41.35. So this gives us a very clear view of the price action. Very important that the market hold this area this week at 43.90. If it does and can clear this 44.50, we could be right back up the other side and pushing right back up here to 4600. So we're in between. And if that VIX, as we saw earlier, to bring this full circle, Nicholas is long, but the VIX is perky. It's showing us that there is some concern. So if we do break this, we would expect that VIX to pop off. And there could be a precipitous fall. So we are most definitely right in between. We would prefer to be a buyer down here and seller up at the highs. And in the middle, we want to be Almost, we want to be on our toes, like a shortstop, go left or go right. Okay, everyone. So this segment is for commentary, and we're going to be very, very brief. This particular video, weekly video, is on the long side, maybe a little bit over an hour, and we try never to go over an hour, certainly during the week. The reason why it is as long as it is we've had a number of new members and welcome at the monthly level, and they're asking and looking at what are these nightly videos and what are they showing and how might I use them. So we were trying to give some insight as to where the market is right now, what we're seeing, and what our interpretation is. Our interpretation is that Nicholas is long. It is what it is. Our interpretation of the VIX is that it is suppressed and still indicating buying pressure. But however, it does show us some perkiness, meaning that the VIX could pop off, which would mean a turn down on the market. The skew is showing us concern, not undue concern, but concern. The market is defensive. The breadth of the market is poor. The daily trends on the market are not good. It's not good. So, and when we look at this particular chart, we can see clearly that the S&P is in the middle of the river. Now, if you've just joined, I know you may be eager to put on a trade and eager to move, but the best of traders need to be, disciplined and patient, and always calculate not the profit first, but if I'm wrong, where does the stop go? All of our annual members have all of these tools on their desktop. They can configure these as in any format they like. And during the Q School, for 3+ weeks, we go through all of this and then some to help that person decide how they want to approach their trading. Intraday, the overall market may not matter that much, but we still want to go through what we go through each and every night, even as intraday traders, so that we don't get broadsided in a market collapse or a market run. It's always a good idea. So Susan and I go through the markets the night before, and that's why we make the videos that we do. They're not edited. We don't come back. So hopefully I didn't misspeak too many times, and hopefully I didn't mess up my whole numbers here, but we don't have the time to go back. We're doing this ourselves each and every night. We're videotaping them and then sharing them with you from the standpoint that you can learn from them, you can glean opportunities from them, and you also may one day have these tools on your desktop and be able to interpret them for your own benefit. And you may see things that I don't see, and please let me know. Also, it's very important to understand the market is not the same. It may appear to be the same. From one day to the next, it might be the same, and even from 1 week to the next. But in clumps of time, from quarter to quarter, year to year, the market is a very different place. And you will grow to appreciate that. We can't impart that experience to a new trader in a day or in a week. It takes time. I came from a surgical background, and I used to make the comparison that, when people are driving up and down the street, they see a hospital, and they see a hospital, and they see a hospital, and they think it's a hospital. They do hospital stuff in there. They do. But they're all very, very different places and very, very dynamic. You might be pleased to learn what goes on in some and not so pleased on others. The market is very much the same. It's a very dynamic place. Sometimes it's great, sometimes not so great. Sometimes it's doing things that you just cannot believe. And as we cultivate these markets for ourselves, we will share our experience and our lessons learned as we go. It's much better to do it as we go. So I hope you've enjoyed this assessment of the markets this Easter weekend. But more importantly, for those that might see this video in the weeks and months ahead, please understand we created this extended version, and for those of the most recent members, as a tutorial of what we're using and how we're organized. In time, we may have additional holes. We may modify others. If you are a monthly member and have questions, let us know. If you're an annual member, of course, and annual members have already been through the Q School. They have access to us through the Zoom class, and don't hesitate. With that, happy Easter, and let's have a great week, everybody. Thank you so much.